Good afternoon. This is Brad Dennis with BIS Commodities with your wrap-up for the first week of March. One word to sum up the first week of March is probably money. A lot of money being thrown at a lot of markets, and it's been an interesting ride to the upside here this first week of March. Start out with the big numbers today out of the financials, the unemployment report. Everybody was expecting 150,000 jobs, came in at 175. They were looking at a 6.5% unemployment rate, came in at 6.7%, which probably allowed the Fed to breathe a little bit better and say, hey, we don't have to talk about any kind of tightening policy down the road here due to the unemployment rate going up. It is what it is out there. You're still seeing a little bit of growth, but you're seeing the equity markets or the equity indexes rise at a little bit more rapid of a rate. And here this afternoon, I think we're talking about it coming back maybe a dollar or two in the SPOOs, but nonetheless, holding on to solid gains out there. So a lot of buyers still coming in, and where it's going to top out at is anybody's guess. You just want to see the growth keep up with what they're anticipating. A lot of stuff has been blamed in the financial markets on the colder winter, saying that we have a lot of pent-up demand. This next month, as we thaw out a little bit, it'll be interesting to see if that pent-up demand does come out to the market. So for right now, Fed policy is stay put. They're going to still continue to withdraw bond buying, so the taper is still in, still a ways away from any kind of interest rate move to the upside. Kind of interesting, with bonds coming down, that usually puts up bond yields. So are we seeing a little bit of money coming out of the bond market and going into equities and into commodities as well? Something that definitely could be happening with that money situation as well. Are we anticipating maybe some inflation down the road, and is that the play that's coming into the commodity markets? Later on, I'll show you some kind of interesting graphics on that. First off, financials. Let's move over to the cattle market. Cattle market made some wild runs this week, and then finally backed off. Last week we were trading at 152 in the cash, 152 and a half. This week more of a 147, 148. So cash bids have backed off a little bit at this time. It's about 2:30 in the afternoon. So we've seen those pull back a little bit. Boxes still continuing to go up, but there's a disconnect on how all that's moving together. Bottom line is, where's demand at? And I think boxes were up another $1.50 this morning, but you only had like 7 loads going out. So maybe the end user or the store's just saying, enough. We're not moving this product quick enough for the prices that you're charging. Over in the hogs, 120 on the June hogs, making new all-time highs. Hearing about possible reduced kill next week, so as the price goes up, we're not shipping out as much. I know that cut out, and I know that the national average is still up there too, and it seems like they want to light a fire under it, but you're still killing 400,000 a week plus. So when the let's say the spec investor comes into the market and buys up hogs, due to the thought of the PED virus, killing half the herd, we haven't seen that. We haven't seen that in the numbers. Kill numbers are still very solid. Cold storage, very solid as well. We saw that a couple weeks ago, and that was at record levels. So you've got pretty substantially higher prices compared to last year in both cattle and hogs, and it's kind of funny because now you're starting to get the national broadcasters to recognize it and talk about food inflation and how that's affecting individuals and how it's not really being accounted for in the overall, like say, CPI and PPI figures. when we look at overall inflation. They feel it is a temporary inflation, so it doesn't need to be addressed too heavily. So one thing that I did want to show you, and it is pretty fun, is the old breakfast trade. So when you start seeing commodity inflation, you say, well, what kind of inflation are we looking at? Well, the first chart here, we'll throw that one up. You can see the orange line there. Okay, what is that? That's your orange juice, okay? So orange juice prices going on up. You know, colder weather that has been tipping down into Florida in case there is substantial damage. Funds are moving money in there. The next one, this is the big one. This is your coffee trade. Coffee, as Dennis Gartman likes to say, from the lower left to the upper right, just exploding. That's your drought down in Brazil in the coffee areas. Now, it's kind of interesting in Brazil, you've got such a big or expansive space that the coffee area is the one that is seeing the drought, and it's hurting that crop down there, whereas in the bean crop, too much rain right now, and they're talking about this amount of rain holding them up from putting in the Serafina crop and maybe going to beans as their double crop instead of Serafina. So that's kind of an interesting thing too. And then finally, there you go. That's the hogs from the lower left to the upper right. These are all May contracts that I showed you, but just gives you an example of how explosive this has been since the beginning of the year or midway through January. A lot of money coming in here, getting these stagnant markets off, up and running. Going over to the grain markets, we're looking at corn having nice gains this week. Took a little bit of a retreat here, whether it was a little bit of profit taking ahead of Monday's S&D report or good farmer selling, probably a little bit of both. Closed the day down a few cents, but still solidly up probably about 15 cents for the week. In a run up to $5 in the front end of this market that a lot of people didn't really see coming. What we're looking at is from December until February, you basically had a 30-cent range, and we were trading the ups and downs, ups and downs, ups and downs. This month, when you saw those hogs breaking out to the upside, OJ, you saw coffee all breaking out to the upside. Well, that caused a little bit more bid in the CRB index, and with that CRB index being bid up, that brought in some more money into the commodities, and that also broke corn up above its previous trend lines. So that's where the money comes in. You know, when you see corn trade, 3,000-4,000 contracts in less than a minute, you know that an algo or somebody's pushing the button to buy, and they just want to own it. So we've seen good movement in corn, and actually since we've switched over here in Cedar Rapids to the May contract, we've actually seen basis come off now. Started out about 2-4 cents over. Now we're about option price. It'd be interesting to see if we go negative on that, and that just tells you that all right, we are getting enough corn out there. There is great movement. It's just a matter of the function of the markets now. Is this movement going to be steady, or is the selling going to dry up here? An interesting thing that's been going on too is in the July DEES corn spread. We've got, according to the government, 1.5 billion bushels stocks out there. Yet we're putting in 10. Actually, overnight you had a 12-cent inverse on the July DEES corn. So it'll be interesting to see if we see that spread adjust a little bit. That'll be the clue that we'll start seeing some selling in those front ends, and maybe that money flow comes back out of there. But until then, nobody knows how much money is there. So you let them take them high and take advantage of this gift later in the season that some producers are going to be able to sell some $5 corn, I think. Over in the beans, same kind of scenario in that we've got a big spread going on between old crop and new crop. And this is probably a little bit more run up to Monday's report. than anything else. A lot of games being played in the sales markets right now. Reporting sales, optional origin and such. And we're really seeing old crop gain on new crop. I think the July nose out to about almost $2.40 right now. And what's been happening is the beans have been bought by China that they've been trying to cancel. Well, those were SIF-based contracts, so that means that the shipping has already been lined up for it. So this year, the sellers of the beans are not letting people out of their contracts. So we do have a lot of beans still leaving the country. The thing is, if you look at where FOB values are, you'd much rather be a buyer of beans out of Brazil that has good logistics this year and actually has some near-term slots that can be filled because they're $1 cheaper, almost $2 cheaper. And that's something that's going to come in down the road. You know, are we going to see us selling high-priced beans out of here, but the savvy guy coming in and buying Brazilian beans because they are so much cheaper? So we either need to see Brazilian beans come up to justify what we're seeing in the market here, or we need to see us break back down and see that demand loss. The other thing in the bean market is we're not seeing a blender's credit anymore. So bean oil that was running is starting to retrace. You're starting to see the funds get out of their longs over there too. So that should be a little bit of a pullback. And in the meal. The meal is another thing. You know, earlier in the hog market I was talking about the PEDs and how we're losing some hogs, yet we've still got a steady kill. Well, if we're not expanding the hogs that much. We know that the cow herd is a lot lower, so that meal usage is cutting back a little bit, especially with the amount of DDGs out there, with the ethanol plants running at very good speed. You're able to utilize those DDGs and not have to pay up for the meal prices as well. So also mentioned a lot about the USDA's report. That's going to be out at 11 o'clock on Monday. Just to give you some ideas, for the U.S. crop, they're looking at an average estimate of ending stocks in corn at 1.488 billion bushels. That's up 7 billion bushels from the last report. Now, the last two reports have had lower ending stocks. I believe this one's going to have lower ending stocks as well. I think that the government's going to go in there and say, hey, with the robust movement and the export sales that we've seen, we'll probably see that number adjusted to the upside. Now, on the other side of that, with the cattle herd being a lot less than what it was last year, we should see a reduction in the feed usage. Unfortunately, with the proximity of this report being at the beginning of March and the quarterly stocks report being at the end of March, the government will probably not touch the feed number, and we'll address that next month. So you rally it up because your demand's going up without any increase in supply, whereas then next month you adjust the ending stocks up because you're taking off from the feed side. It'll be interesting to see how that all works out. Bottom line is you're looking at increasing exports about 1 billion bushels as opposed to what we did last year. You're looking at increasing feed usage 1 billion bushels from what we did last year, and we'll still have over 1 billion bushels ending stocks. So that's going to be carried through to next year. So you get a decent crop next year. That just triggers things or accumulates those ending stocks, and we're just going to have higher and higher numbers, which should theoretically push the prices lower. Over in the soybeans, last month we had the USDA talk about a 150 carryout. Average estimate is about 141. Realistic number is 130. Absolutely. We have booked, I think, 100 or sold or have expectations to sell 107% of what the government thought we'd sell. So I think we're at a 1.510 on export sales. We actually have anticipated sales to be 1.537. So about 27 million bushels over what the government previously thought. So if you take the carryout of 150, you subtract that 27, you're at a 123 carryout. Now, I don't think that the government really wants that thing to get any tighter. So you've got a couple avenues that you can go through, and this could be the creative accounting that comes into play. You could see the residual that's at 99 right now be reduced. Let's say you take 10 million off of that. You're down to 89 on the residual. That'll help keep that ending stocks number at 150. Over in the crush, we've been running about past couple months, we've been lower crush than what we were last year. Last year we were 1.689. This year we have an estimate of 1.7. That's 11 million bushels that we could say, hey, we're just going to be at the steady crush level of last year. So now we're up to 21 million that we can add on there. And then the exports, with the difference in prices, and we've heard of people, probably people in the south, east quadrant of the states, bringing in meal and beans for June and July already because they don't want to have to deal with the higher prices that we're seeing on the board right now. We could see imports being bumped up, 5, 6, 7 million. Boom. All of a sudden, that 27 million bushel increase comes out of the residual imports and a little bit lower crush number. So we'll see if it's creative accounting or not. Granted, we still have a tight bean situation, but you've got to remember we have an enormous crop down in South America. If you argue between 88 million metric ton and 87 million metric ton, I ask you, what's the difference between the two? It's still a record crop, and it's more than they're going to be able to export this year. So I think that has to be seen as we're going to build this thing up to a point, but is there a bubble that's brewing in the bean market? Wild cards, still the Ukraine situation, and that's going to come into play down the road too. You're hearing right now that there's double bookings going on. People aren't trusting the Ukraine to get grains out. Now they have estimated on the books, the high end of the estimate is 10 million sales, 10 million metric ton of sales that they have to get out of there. That's actually on the books right now. So that's about 390 million bushels. We'll see if that comes out, see if there's a little bit of double booking there. It's a very dynamic situation, and yes, it probably causes some fear premium to come into the market, and I think that's a little of what we've seen in the front end of this corn market. So lots going to depend on what the government tells you on Monday. They're leaning higher in beans. If the bull doesn't get fed, maybe there's a little bit of profit taking there. Over in the corn, I honestly think you probably get a fairly neutral report there, but that's not going to stop the technical trade when you continue to make higher highs, higher lows. We'll see if producer selling can stop that rally or not. And then over in the wheat, actually, they're looking at the estimates are for higher wheat stocks. But we knew that the fund was coming into this week, I think, short about 20,000 contracts, and they're paring back that position as we talk too. And you've got to factor in the Ukraine situation with the wheat market as well. So interesting develops there. One little known commodity that we don't really address too much is the oat market, and we've seen that oat market go to 540, well over where March corn is. Today we were limit down in it. There's some rumblings about legislation that's going to be passed or is trying to be passed up in Canada that will allocate more rail cars to grain movement to try to get this tremendous crop that's been locked in a deep freeze up there all winter out to the ports and out to the people that need it. So that's going to be a situation too that maybe that frees up the logistics and we're able to see grain move a little more freely. If that happens, you could see that getting to the market quicker and being detrimental to prices as well. So a lot of issues out there with the dynamics of this grain market, and a lot of situations that are very fluid that kind of turn on a dime. So just got to be able to react and got to remember too that when these funds do get in on the long side, what's the best risk management for your business? How do you handle it? How do you take advantage of it? And that's what we're here at BIS Commodities to help you with. So that is all for today. End of message.